Hello and welcome to this recording. In this recording, we are going to discuss about mutual funds. So, what is a mutual fund? So, mutual fund is an indirect way of investing. It's not a direct way. So, what happens in a mutual fund? So, all investors they pool their money. They give it to an AMC, an asset management company that has a fund manager, and that fund manager invests on behalf of you. So, two important things. Investors are pooling money, they're giving it to a third party called as the fund manager, and fund manager is handling that money, investing that money on behalf of investors. Whatever return the fund manager makes, the fund manager passes that on to the investors. Now, for providing this service, the fund manager is generally paid an monthly commission, or so it's generally paid an annual commission. So it they means the fund manager generally takes a certain charge. So this is how it works. Investors pool money, they give it to the fund manager. The fund manager invests on behalf of investor. Whatever return he makes, he transfers it to investors, and for his services, he charges certain fees. So why investors purchase mutual fund? An investment chosen by the people who pool their money to buy stocks, bonds, or any other financial securities selected by professional managers who work for investment companies. So these are professionals who handle your money. Each investor has the right to proportional share of asset of the fund and any income it earns. So you get a proportional ownership in the pool. So if the pool is growing, your ownership in that pool is also growing. Also, whatever income is generated by that pool, you get a proportional ownership of that income. For example, if I invest $100 and the pool is of $1,000, I get 10% ownership. So I have 10% ownership in the pool. As the pool grows, my ownership also grows, and I have 10% ownership in income that it generates. Many people choose mutual fund for their retirement account. Advantages. So why investors purchase mutual fund? The advantages of it is professional management. So you are not handling money, some professional is doing it. So important questions are, who is the fund manager? Managers can change, so investors need to be careful. Mutual funds are famous for their fund managers, so you need to be careful whether the fund manager is changing or not. Then diversification. As an individual, I have limited money, so I can only buy limited stocks, so I cannot diversify much. But a mutual fund pools money, so it can buy many stocks or many bonds, and it can diversify its holdings. So investor pools are pooled and are used to purchase a variety of investments. Funds own stocks in hundreds of different companies, buys from different asset classes like stock, bonds, and other securities, so they diversify better. An investment company is a firm that, for management fee, invests the pooled funds of small investors in securities appropriate to its stated investment objectives. Now, there are two types of mutual fund: close-ended mutual fund and open-ended. So, close-ended means we'll first start with open ended means you can invest anytime with the fund, you can withdraw money anytime from the fund. So when you invest, you get units, and you can go back to the fund and say, take these units and give me back my money. So you can sell those units back to the fund at the net asset value of the unit. Okay, so you can invest anytime, you can withdraw anytime. So it doesn't have an investment period, it doesn't have a lock-in period and a withdrawal period. The disadvantage of open-ended is, to maintain this liquidity of people coming in and going out, they always need to have some cash. So they don't invest 100% of the funds that they get. Certain proportion is kept for cash. So that decreases the overall return for the fund. Close-ended means the funds are locked in. So you cannot go to the mutual fund and ask for your money, but you can sell those units that you have to some other investor. So close-ended funds are generally listed on exchange to provide liquidity. So even though you cannot go back to the mutual fund for money, you can sell those units on an exchange to some other investor to get your money back. Advantage of close-ended is generally, since there is a lock-in period where company doesn't have to keep liquidity, it will invest 100% of the amount that it gets. So close-ended, it is a fund of finite size. Shares are issued by the investment company only when the fund is originally set up. There is no more issues later on. Those are called as NFOs or new fund offers. After all original shares are sold, you can only purchase share from another investor. Open-ended mutual funds. Shares are issued and redeemed by investment company at the request of investors. Investors can buy and sell shares at net asset value. Now, net asset value is the value of units that you have. So the current market value of securities contained in the mutual fund portfolio minus the mutual fund liabilities divided by number of share outstanding. It is calculated at close of trading day each day. So how much value of fund it is there? So value of funds portfolio minus liabilities that the portfolio has divided by number of shares outstanding. Now, types of mutual fund. So there are index fund. Index funds generally invest in some equity or a bond index, and they are very efficient way of investing because the cost, there is no active management. So the fund manager is only buying stocks that are there on index. He is not using his own intuition about stocks. So since the active management is low, the fund charges are low. So index funds are an affordable way for investors to invest in a diversified basket of securities constructed to track the components of market index such as S&P 500 or S&P TSX Composite. Exchange traded funds or ETFs, these are an affordable way for investors to invest in a diversified basket of securities, provides the diversification of index fund with the flexibility of stocks. So index funds that are listed on exchange are called as exchange traded funds. Short selling, you can short sell exchange traded funds, the practice of selling a borrowed stock in the hope of covering the sale by buying. So we have discussed it in stock investments. Margin sell or short sell is when you borrow a stock and sell it and then buy it back and return back the stock. So you can do that even with exchange traded funds. Now, charges on mutual funds. So there are generally load funds. There are three different types of charges. Mostly there are other charges also, but three major types. First is the front end load. It is the amount of commission you have to pay when you buy a mutual fund. Then there are management charges. These are annual charges that you have to pay because you are into the mutual fund. Then there are back end charges or back end loads. That is the charges you have to pay when you sell the fund. So these are three types of charges. There are load funds that have all three. There are no load funds who generally have only management charges. So a load fund is a mutual fund in which investors pays a commission. It can be as high as 8.5% every time they purchase or sell shares. Contingent deferred sales load. So generally you don't pay when you buy, but you pay when you sell. No load funds, there are no sales charges in buying and selling. Front end load, it is a sales fee charged with each purchase, reduces the fund actually invested. Most fund companies have lowered the maximum front end load on their fund to around 6%. Back end load, also referred to as contingent deferred sales load, 1 to 6% of withdrawals on the sliding scale decreasing with time, and then 0 if you sell it after a number of years. So if you sell before a certain years, you are generally charged when you sell it, but after a certain years you are not charged. Expense ratio, expressed as a fixed percentage of funds total value, generally called as management expense ratio or MER. It ranges from 0.25 to 4%. This is there are generally funds right now that are charging you 0.02% also. They are all based on artificial intelligence, so there is no human involved, so they can reduce the cost a lot, right? It can be as high as 4% to cover investment company's cost. The fee is 0.5% higher for back end load funds. So this is the annual fee that you pay. It ranges from, as the book says, from 0.25 to 4, but there are certain new funds that are coming in that are lowering the cost even further. Special fees, so you have to pay for RRSP charge, RRIF charge, RESP trust fees if you're adding those mutual funds in those accounts, account setup fees, short-term trading fees, processing fees, service fees, etc. These are add-on to the three major fees. So this is something we have discussed, but we'll just go through it quickly. Load fund, either front end or back end sales charge. No loan fund, no sales charge. Front end fund, a sales fee charge with each purchase reduces the fund actually invested. Most fund companies have lowered the maximum load to around 6%. Back end, also referred to contingent deferred sales load, 1 to 6% of withdrawals on a decreasing scale as per time. 6% if sold in year 1, 5% in year 2, and it goes on to become 0 after 7 years. Management fees, annual fees that you pay, expressed as a fixed percentage of fund value, called the management expense ratio, ranges from 0.25 to 4% to cover investment company's cost. The fee is up to 0.5% higher for back end funds. Next is money market mutual fund. So these mutual funds invest in short term instruments, so short term debt, extremely safe, then they are relatively less risky and extremely liquid. So income and liquidity through investments in short term money markets. So example, they invest in T-bills, commercial papers, and short term government bonds. Mortgage fund, they invest for income and safety. So generally they invest for income and safety. Mortgages, they generally buy loans from loan companies. So example, I'm RBC, so I have $100 million worth of loan, and those people who have taken loans from me pay it back. So I'm taking, let's for example, housing loan. So these mutual fund companies buy these housing loans. So when the actual loan holder pays the bank transfers the money to mutual fund company. So aims for income and safety, holds a group of mortgages. They are relatively safer than bond funds because you have assets there. Bond funds aim for safety of principal and income but are subject to capital gains and losses which have tax implications. They invest in corporate and debt securities. The dividend fund, they aim for tax advantage and income. You have possibility of capital growth. So these funds invest in companies that are relatively safe and pay extremely high dividend. So generally utility companies aim for tax advantage income because dividend is taxed better than the interest payments. Possibility of capital growth is there. They invest in preferred shares and high quality common shares. Then balance and asset allocation funds, they provide mixture of bonds and equity. So they invest some part in bonds and some part in equity. Provides a mixture of safety, income, and capital appreciation. Equity or common stock funds, they invest in common stocks. So you get capital gains by investing in common shares. Specialty funds, so equity funds generally invest in the overall market. Specialty funds only focus in a particular sector. So they sacrifice diversification in an effort to build capital gains. They generally invest in one industry or a geographical area. They invest in a segment of capital market, not the overall market. International or global funds, these are subset of specialty funds. So they invest in international markets. Real estate funds, long-term growth through capital appreciation. They invest in real estate, which is income producing. Ethical funds, these funds have certain ethics that they abide by. For example, Norway's pension fund generally doesn't invest in companies that are in tobacco or they are in producing arms, etc. So investment decisions that are guided by a moral criteria that is mentioned in the fund. Segregated funds, so insurance companies are as an alternative. So segregated funds means some portion of your fund or whatever you invest is guaranteed, and you also get exposure to capital appreciation. So guarantee is the insurance component, but the issue with segregated fund is the cost is generally high. So segregated funds, some portion of your investment is guaranteed, unlike the mutual funds, and rest of it is floating. Disadvantage, you generally have very high management fees. Guarantee that portion of your principal will be returned to you at maturity. Labor sponsored venture capital corporations, they are sponsored by labor organization, they invest in small to medium size businesses. Now, there are generally fund families. For example, Sun Life fund family, Scotia Bank fund family, RBC's fund family. A family of fund exists when one investment company manages a group of mutual funds. Funds in the family vary in their objectives. So some can be stock, dividend, bond, etc. You can move your money from one fund to another within a fund with low or no charge. But when you move from one family to the other, you have to sell and then buy. But if you're shifting within a family, the charges are generally lower or there are no charges. Market timer, so this is a recent concept. He's an individual who helps investors decide when to switch their investment from one fund to another, usually within the same family. Now, how do you evaluate a mutual fund? So you perform a financial checkup to make sure you are ready to invest, obtain the money needed to purchase mutual funds, determine your investment objectives, find a fund with objective that matches your own, evaluate any mutual fund before buying and selling. So first you should figure out whether you are ready to invest, then obtain money, determine your investment objective, so based on your risk and return, and then try to match the mutual fund, find a fund that matches you, and then evaluate. So mutual funds, generally newspapers have sections on mutual funds, so they will give you net asset value, that is how much is the per unit value of the mutual fund and how much it is changing, company and fund name, fund objective, return over various time periods, ranking among fund with same objectives, and whether they are sales load or no load funds, and how much is MER, that is management expense ratio. Mutual fund for prospectus is a statement that describes the different risk factors. So whenever you buy a mutual fund, you get a prospectus. So it describes the risk factors, a description of funds past performance, a statement describing the type of investments, information about dividend distribution and taxes, information about fund management and limitations that they follow when choosing investment. Mutual fund prospectus gives you process to buy and sell shares, service provided and cost, how often the investment portfolio changes, provides a wealth of information to help you make an informed decision, summarizes fund objectives, and provides the summary of fees. Other sources of fund information can be mutual fund annual report. So they give you an annual report that gives performance, investments, assets, and liabilities. Then there are guidebooks, financial publications, and you can just search on internet. Advantage of mutual fund: diversification. So by not putting all your eggs in one asset, you can diversify better through a mutual fund. Professional management, ease of buying and selling, small amount of money is required to open an account, multiple withdrawal options are there, distribution or reinvestment of income and capital gains, then you can switch within a family, and there are other multiple services that are offered. Disadvantage, there is generally a purchase and withdrawal cost, there are ongoing management fees. There means it doesn't mean that since professional is dealing they will not make any mistakes, so there is potential for poor performance. No control over capital gain distribution. It means if a mutual fund company is buying and selling shares, you have no control over it, but still that will be taxed in your account. So if it is buying Apple and selling Apple at a profit, it will incur capital gain. That capital gain will be transferred to you. So even if you are not part of the decision making process, still you will be taxed. So there is no control on taxation when you invest in a mutual fund. There are complicated tax reporting issues, potential market risk with all investments, and some sales professionals can be extremely aggressive. Mutual fund transactions include return on investment. Okay, so how does a mutual fund pay you back? So you invest in a mutual fund. So whatever buying and selling it does, and it generates capital gain, that is transferred to you. Whatever dividend it gets through stock investments or preferred stocks, it gets transferred to you. Whatever interest it generates in money market instruments or in, let's say, bond and mortgages that it has invested in, that also gets transferred to you. Also, you can buy some units at X price, and if performance is good, they can increase in price and you can sell it to another investor. So that is also one form of gain. So mutual fund will transfer certain things like capital gains, then dividends and interest income. So they will transfer whatever they are generating. Then also you can buy at a certain price and sell at a certain price. So income distribution, the earning a fund pays to shareholder after it has deducted expense from its dividend and entrance. Capital gain distribution, the payment made to mutual fund shareholders that result from sell of security in the fund portfolio, and you can sell shares at a higher price than you paid always. Taxes, most of the returns are subjected to taxation. Company is required to send statements specifying how much is received in dividends and capital gains. Although you do not receive cash as the returns are reinvested, but you still are taxed. So if you have invested in a mutual fund and the mutual fund is buying Apple, selling it and buying some other stock, you're not getting any money out of it, because whatever gain it made, it reinvested, but still you will be taxed. You can be taxed in a year when your burden is already heavy, may be taxed for a full year even if you are invested only for the part of year. So example, if I buy it in December, so I'll be taxed for whatever has happened in the mutual fund before me buying. That's an issue. Purchase options, so closed ended you can buy through stock exchanges, open ended no load directly from the investment company by phone or through emails or internet, or you can buy it through sales representative. Reinvestment plans that the mutual fund have, so dividends and capital gains that they pay you are not paid actually in your account, but they are reinvested in the mutual fund. So one interesting fact, 52% of the funds that are bought in Canada are balance funds. So we buy balance funds a lot, followed by equity funds and then bond funds. Withdrawal, so close-ended funds can be sold to another investor. Open-ended funds can be sold to investment company that sponsors the funds. So shares are generally redeemed at net asset value. Withdrawal can be specified, so you can do a lump sum withdrawal or you can do it in parts. So you can specify a dollar amount until the fund is executed or exhausted. You can sell certain number of shares over a period, withdraw a certain percentage, you can state the percentage, or withdraw all asset growth and leave principal untouched. You have different options. So that is it in this recording of mutual fund. We'll meet in the next recording.